All right, hey there, folks. This is David Kinitsky, COO of Dominant Stratgies, development company for Quai Network. I'm here with Dr. K, the inventor, co-founder, and CTO of Dominant Stratgies and Quai Network, and we're going to be covering decentralizing stablecoins today. I think we'll kick things off by discussing some topics. Why do stablecoins matter? Why does decentralizing them matter? What do we mean by decentralizing them? What do we see in the market, and what do we think the future for that market is? And then we'll open the floor to some folks if there are any questions out there. So without further ado, why don't we kick this off? And feel free to raise your hands, but expect that for the first 20 minutes or so, we'll go back and forth here to kind of lay the groundwork before we get into that. So thanks for joining me, Dr. K. How are you doing today?
Long day, man.
A long day in the mines, developing the network. I hear you, man.
Yeah.
Well, thanks for joining us and taking the time in the after hours session. So, just to lay the groundwork here, in your view, why do stablecoins matter? Why do we even care about stablecoins if we have Bitcoin? And why does decentralizing stablecoins matter? And what do we mean by decentralizing them in your view? Why are we talking about this today?
Yeah, I think the reason stablecoins are important is because they are actually probably one of the best product market fits shown in crypto, right? Having the characteristics of crypto where we can sort of send things in this global non-intermediated way and hold things without needing the permissioning of banks or governments to hold certain assets. There's clearly a product market fit, so much so that about 70% of transactions by value currently are stable tokens. So it's clear that if you're going to have an economy, you need a numeraire, you need a denomination for pricing goods and services so that you can make that process as frictionless as possible, which is the point of money. So having something that wildly fluctuates in value like Bitcoin isn't great for pricing goods and services or writing contracts. So that means a system like Bitcoin or Ethereum or any really crypto system up to this point, is dependent on a stable token of some form, and all of them really are fiat pegged at some level if it's custodial or if it's algorithmic. But that makes them then dependent on the traditional banking system, the fiat system, and the government, really.
Mm-hmm. And so in your view, you talk about the product market fit. I totally agree. In my view, there's probably 3 product market fit-ish things in crypto to date, and only 3. A sovereign store of value, which you might say Bitcoin is, a kind of smart contract, programmable finance, maybe you say a casino of sorts with Ethereum and others. And then, as you say, stable coins, which are probably the closest to what many would consider a real, quote unquote, real world use case. So I'm with you there. And why does decentralized stable coins matter? Why does it matter? It seems like if you're saying there's a product market fit and a lot of the transaction values in stable coins, and those stable coins are currently filled by and large, USDC and USDT, which I think you're characterizing as centralized. Why is that a problem?
Yeah, it's a problem for a number of reasons. The reason crypto is interesting is because it has these, or one of the main reasons is because it has these non-custodial, non-intermediated characteristics. And to have those characteristics, the systems have to be decentralized. If they're not decentralized, you're going to end up losing those characteristics. So the issue is, if we take the custodial sort of example of USDC, Ethereum doesn't have USDC in it. It has hypothecated receipts that represent a dollar that we call USDC, but there's no USD itself in Ethereum. It's all being collateralized and custodian by these banks via Circle and Coinbase. So when SVB went under, USDC depegged because SVB was insolvent, and SVB was one of the main banks holding reserves for USDC. So we saw USDC go down to, I think it was 82 cents or something, because everyone was concerned that SVB's insolvency was making it so that Coinbase and Circle wouldn't be able to make redemptions on outstanding tokens. That's one example. But there's actually many deeper levels that you can go down besides just the custodian example, in terms of how being dependent on the traditional financial system for the denominating asset or numeraire makes it so that the decentralized system is no longer decentralized. And we can get into that a little bit more if you want.
Yeah, no, I hear you. I mean, you're right. I think like USDC has taken some measures to try to guard against the SVB type scenario that you're describing, but fundamentally you're correct. I mean, you have these like assets that are custodied somewhere in the traditional financial system. I think by and large, the assets for USDC, for example, are now held in a BlackRock kind of like dollar equivalent fund or money market fund of sorts. But USDT, which is even like by like, maybe like 3x bigger, has like an interesting diversified portfolio, which is a little bit, some would say riskier, however you want to characterize it. But fundamentally, you're right. Underlying these tokens is an IOU or claim on a pool of assets that is custodied in the traditional financial system and managed by them. I think there's a couple other vectors when I think about decentralized or centralized stablecoins. It's funny, people talk about decentralized stablecoins as if they exist, but I don't think there is like a pure play decentralized stablecoin that exists in crypto yet. I think by and large what they're talking about is just on-chain or on-chain native or crypto native. But there's kind of the underlying assets in custody that could be centralized or decentralized. There's the oracle or price feed and stability mechanisms. Then there's like governance, censorship, and control levers. And so there's a couple different vectors along which you might characterize something as centralized or decentralized. And to date, there's certainly not one at any sort of scale that is a decentralized stablecoin. Even the ones that people point to, the original one being DAI, but DAI is obviously now split into two. Even ones like Rai and others that are Gyroscope, that are more quote unquote pure play decentralized stablecoins, really still have this mechanism of either an oracle or set of oracles that they rely on that are pegged to USD. And if you're pegging to USDC, that is naturally a centralized mechanism that is controlled by a government. Then you have governance mechanisms that are on chain, but still kind of like controlled by a DAO, often by big players. Then you have kind of certain, if you want to be compliant, certain censorship or control mechanisms. So I think it's really interesting when people just say decentralized or centralized as if it's like a binary mechanism, but it isn't. It's a bunch of different vectors and it's kind of a spectrum. So in your view, what is the proper or actual decentralized stablecoin look like?
Yeah, so maybe just to give a little bit of kind of like context of the existing stable token market, just to try to make it simple. The oldest form of this was actually USDT. USDC is a much newer comer than USDT, but those two assets represent just collateralized stable tokens. So you have a bank, you have an issuer, they hold money in the bank, and then supposedly for every dollar they have in the bank, they'll create a receipt for an on-chain dollar. And then if you redeem that dollar, they'll destroy the sort of receipt, and they'll then pay that dollar out in a normal sort of fiat denominated account. That's what we would call a custodianed stablecoin. After that, the sort of second class of stable token was introduced. I think DAI was probably the first one to do it. And
certainly at scale, yeah.
Yeah, so Maker DAI would be the other form of it. And this is a concept of a stable token that's based off of a collateralized debt position, or a CDP. And that's really kind of what you need for an algorithmic stable that's pegged to a fixed asset. You're going to have some amount of assets be taking risks against some other set of assets. So basically people are going long and short. That's where the debt positions come into play. So you basically have Maker, and Maker is backing up. It's the governance sort of token for DAI, but the value of Maker is sort of backing the peg against DAI. Right. So if DAI is to sort of break the bank because CDPs close fast enough that comes out of Maker. And sort of the more pressure there is on DAI, sort of the value is lost from Maker, is kind of sort of how the setup goes. Now with CDPs, from a decentralization standpoint, if we assumed that we kind of had like a good oracle, they're technically not a terrible design in terms of decentralization. There's an issue of like, I have this governance token, the governance can change the contracts can update. You could hypothetically have a static contract that can't be updated. Now, that gets rid of that problem. Then the second problem though is like, what do you do about the oracle? Right. And if you're going to a pegged market, you're always going to have an oracle problem. And we've actually seen a number of stable tokens and then DeFi protocols and lending protocols get hacked because of issues with oracles or liquidity in oracles. And then people can exploit that through a process of flash loans. And then you can suddenly drain like entire DAOs worth hundreds of millions of dollars because this oracle was able to slip the price for one block. And then suddenly all the money's gone, right? So oracles are a very pernicious thing because something like a dollar market relative to Maker or Ethereum, you don't have really good, robust oracleization mechanisms. And I don't think you can really get rid of those. So that's kind of like an issue that has. Now, the other issue that's maybe economically more interesting is the fact that DAI was probably actually responsible for the 96% retracement in Ethereum's value in 2017. Like Ethereum corrected harder than almost any other asset. And if you actually watch why that correction was taking place, it's because DAI vaults were getting liquidated. So what ends up happening is with the CDP, you can take leverage on Ethereum. It's only leverage of like 1.5%. But as there's pressure on the value of Ethereum, your funding rate goes up. And so then your like collateral keeps like shrinking faster and faster and faster. So you were paying say 3%, then you're paying 5%, then you're paying 15% on that money. And simultaneously the prices of Ethereum is dropping and you still have to maintain the over collateralization. You end up getting these situations where these CDPs get liquidated and the liquidation process is effectively selling that ether at market. And when that happens, it causes this like positive feedback loop where if the price of ETH drops, CDPs get liquidated, the price of ETH drops again. CDPs get liquidated, the price of ETH drops again because it's just this cascading like hitting of like limits that are taking place. And if you look at the retracement on Bitcoin, it wasn't nearly as bad as the retracement on ETH. So there's issues of centralization there. There's issue through the oracleization and the governance. The governance one might be able to be solved. The economic one in the CDP is actually pretty like terrible as a design mechanism. You're almost better off just like exiting into dollars. Because if I were to like exit in and out of dollars, you wouldn't have these like positive systemic feedback loops during these points of price crashing. Yeah.
It's interesting. I'm when I look at like the stablecoin market, the current market you're talking about here, to give some context, obviously when you look at reports, it's absolutely dominated by USDT and USDC, both in terms of the market cap or monetary base of those assets, as well as in terms of like transaction volumes. But in terms of number of projects, I'm actually seeing a proliferation and a long tail of interesting new projects. And some of them are, other centralized USD projects, like from PayPal and others. Some of them are USD centralized ones that offer native yield. Some of them are non-USD fiat ones, like in Euro, Great British Pounds, things like that. Things that are centralized but commodity-based, physical commodity-based, like gold or silver or some other metals, things like that. You're actually seeing ones that are now trying to be privacy-oriented, but when you peg it to a quote-unquote RWA or real-world asset, fundamentally you have that Oracle / stability mechanism CDP structure that has vulnerabilities. Now, people are getting better at it, and I'm hopeful for that. But one that like kind of part of that tail that I'm really interested in is not physical commodities, but more physics-based commodities. And there's a couple projects in this, like Quai, that are based on computer energy. And I think it beckons the question of what we actually mean by stability. And there's a notion of like what I would call rigid stability, which is basically, can I track the price of this other thing, versus robust stability, which is, can I maintain a relatively strong purchasing price power over time compared to whatever economy I'm in, right? And that's where I think the really interesting thing to explore here is that the Quai is doing some other projects like the Mel project and some others that are based on energy or compute, assets that fluctuate in terms of dollar basis. It's really hard to think about what stability and price is without dollar as a numeraire or denominator. But when you think about your purchasing power over time, what you can buy, how much the value that you hold is worth in terms of the goods and services you may want to exchange them for in the future. This idea of robust stability, something like energy or compute, that over time is like a fundamental asset or price that is kind of naturally connected to the economy that you live in. And that's like a really interesting one. How do you view kind of that notion of like, what is stability in this world? And it's kind of a tough concept to wrap your head around when you start thinking outside the box of USD. How can people kind of like wrap their heads around the concept of something that isn't fiat based as a denominator or numeraire?
Yeah, I mean the way I think about it is, like, what you ultimately care about as a consumer is what you can buy for whatever money you have, right? And the denomination is just a convenient unit of measure so that you can sort of plan and price without too much cognitive burden, right? So if I had something that was wildly fluctuating and I went to get a coffee at Starbucks and one day it was $8, the next day it was $4, the next day it was $6. I would kind of have difficulty cognitively dealing with those price fluctuations. So that's kind of like a Bitcoin sort of scenario. But fundamentally, from my perspective, I'm most interested in just like, how many cups of coffee can I get, right? Or how many roast beef sandwiches can I buy, right? Or how much is this many Chevrolet pickup trucks I can buy with it, right? Like that's my concept of stability. So when I think about the dollar, it used to be that you could go into Starbucks probably only 10 years ago and $4 you were out with a espresso drink. And now it seems you get espresso drinks and each one of them's like $8, right? And that's inflation for you. Now, the thing that the dollar does for us is it gets this idea of low volatility, but it's always losing value. So over any given period of time, if it's 1 year, 5 years, 10 years, certainly these days, it feels like it's every year that it's losing significant amounts of its value. I can price in it from day to day, but I also know that from year to year, my dollar is going to be worth less and it's going to get more expensive. So I'm forced into this game of, if I want to maintain my purchasing power, I need this dollar unit that's non-volatile to sort of like easily price and transact things, but then I also need something that's going to preserve my value. So It's actually forcing every saver in the economy to speculate or invest or do something, because they can't just hold their wealth in dollars and expect to get ahead, because they're just losing any wealth they can possibly accumulate. So, BLS, right? Like they come up with like CPI numbers, but they might say inflation is 4% core, but in reality, we all know, and if you look at numbers, that's much closer to real inflation of 10 or 15% in any given year. We've seen some like pretty high years of inflation in the last couple of years. So if you're thinking about like your total aggregate wealth in life and you're trying to sort of accumulate and get ahead, if you're always losing 10% of your stored up value every year, is there like any possibility you're ever going to like get above a certain threshold? Yeah. You're just going to like logarithmically tail out. So, by the time I've worked for 10 years, unless I'm significantly increasing my earnings every year over year, by year 10, I'm never going to get more wealthy again, because I've peaked, because I'm just going to be always running against inflation. So what I make every year is going to get eaten up in inflation every year. So there's like a cap on wealth that exists unless you go into hard assets, gold, land, investing in stocks, Airbnb, like hustle. And that's what you see everybody doing in this economy, right? Is anyone who's trying to get ahead is like trying to run a hustle of some sort, flipping homes or renting or something. Mm-hmm. But in terms of what I think of as stability, I think of it as trucks, coffees, and beef, It's like
Yeah.
my thought process.
Big Macs, the Big Mac index.
No, not Big Macs, man. Grass-fed, pasture-raised,
that's a version of
antibiotic-free.
You're talking about a version of like shrinkflation, right? Which is where like maybe the price doesn't change, but the ingredient mix does, and you're actually getting watered down on that side of the equation. Because like Big Macs used to have like pretty quality beef, pretty quality like.
Well,
buns.
they used to fry those.
Yeah.
McDonald's
beef
used
tallow,
used to use tallow in the fryers, man.
That's right.
And
yeah.
now we're canola oil.
Right. So that's
Crap.
the other side of the measure, right?
Yeah.
It's like they're just measuring inflation, but there's like the shrinkflation or some version of it where it's maybe not just size, but ingredient mix as well.
It's kind of interesting. I've definitely gotten much more health conscious, specifically food conscious, in the last couple of years. And I was just thinking back, my sort of adolescence through high school was probably the peak of just like absolutely horrifically bad for you concepts of processed and packaged foods. Right? When I was in high school, people were like, oh, Sun Chips are like a healthy option.
Yeah.
And everybody would have a slice of pizza and Mountain Dew for lunch. And this was just like a normal everyday existence that wasn't like thought of as bad. And looking back on it, you're like, how did I even live through that?
Yeah.
I mean, it's just crazy.
Yeah.
You know, but I think if we go back a little further in time, right, getting off of the gold standard in 71 fully, when Nixon closed the gold window, right, there's many a graph that shows that the aggregate real purchasing power of U.S. homes has been declining since then. And that's why I think you see the rise of processed food with worse ingredients. You see the concept of having to have two employee households where both the husband and wife are working so that they can afford to have kids and go to school. And like even kids are getting expensive now, even with two people working. All of that has to do with coming off of a real valued standard tied to real energy and value, i.e. gold. And in doing that, the government's just been eating away at society for the last 50 years now. And it's kind of coming to a head in terms of what they can get away with surreptitiously taxing us via inflation every year.
Yeah.
But yeah, when I think of stability, I think of real world assets. I think of the things that I consume. So, you know, if I can buy more steaks next year than this year, I guess I'm making more money.
Yeah. So before we get into like predictions for the future of stablecoins going forward, I want to hone in on this idea of stability. Some of the things we talked about, decentralization, notions of stability. And one of the things that drew me to Quai actually was kind of this interesting notion where something like energy, right? It's a fundamental asset in the economy. It's like an input to pretty much all of the economy, let alone all of life. But you get this kind of nice real world asset. And then there's this kind of nice kind of back and forth where not only is that a nice choice for a point of stability reference, but in terms of its implementation, it has some nice properties via proof of work and via its naturally decentralized mechanism where you can use proof of work like an oracle and then avoid some of the governance and other centralizing forces that we talked about. Talk to me about your thought process there about why is energy in particular, even maybe more than compute or other things, a particularly good choice for robust stability measure? And then talk to me through that chain of events that also make it a good choice to decentralize the notion of a stablecoin.
Yeah, I'm gonna take the long way around here. So it's interesting, right? I'm an engineer by training. I actually started out working in vehicles, electrification, batteries, etc. One of the things that people would always talk about in making vehicles more efficient is what's sort of the overall efficiency numbers, right? So if we look at ethanol and you say, what does ethanol do to the system? Is it carbon positive? Is it carbon negative? Is it more energy intensive? Is it less energy intensive? Like what's the total aggregate, like real cost? And you can do the same thing with like plug-in electric hybrids. Right. You know, if I have a vehicle and I have to burn coal or nuclear or something, maybe some of it's wind and solar, but I have some creation source, then I have to transmit it over lines, then I have to take the efficiency loss of putting it into the battery. I have to account for the fact that battery has a finite lifetime, so I have to depreciate the capital cost over every use that I have of that system. so on and so forth. You have to take into all of this into account when you're trying to say, is a hybrid electric better than a gasoline vehicle? Is gasoline better than ethanol? Is that better than a fully electric vehicle? Is lithium ion better than lead acid or nickel metal hydride? There's all of these like choices that are happening. And what I noticed in all of these analyses, because people would write very long papers and would argue over the efficiencies and the assumptions and the markets and the pricing. What I ultimately came to was that whatever is the lowest cost thing in aggregate is the most energy efficient thing. Mm-hmm. That is like the reduction that gave you the most accurate understanding of the total energy in the system was the cost. 100%. Now, the one thing that makes it a little bit tricky in a market like that is you have to think about the sunk capital investment cost. Right. But if we can sort of normalize that out, and that's the biggest unknown factor in the whole equation.
Of marginal variable
cost.
Right.
Yeah, but if you just look at marginal variable cost, that is your energy consumption, 100%. So if you guys love the trees and think we're gonna all die from carbon emissions, you should ride a bike. If you're not riding a bike, you should have a used Toyota Yaris from 10 years ago. You shouldn't be buying a Tesla because the Tesla has a much higher variable marginal cost than your 10-year-old Toyota Yaris. Mm-hmm. So the cheapest thing you can do will have the lowest carbon footprint. If I can grow a tomato in my house using rainwater capture and transport it 40 feet to eat it, lowest carbon impact that I can get relative to going to HEB and getting one that was grown in Florida versus getting one that was grown in Guatemala and shipped up in the wintertime, right? So it's all about cost is a direct reflection of energy consumption.
So I think I know where you're going next.
Yeah.
So take me to the next step, what I think is maybe proof of work, but go on.
Yeah, so that's kind of the first realization is that if we're thinking about competitive goods in society, the price you pay is ultimately the energetic representation in aggregate that went into that good. And this even includes the intellectual input as well. Mm-hmm. Now, what I said there is in equilibrium on competitive goods. But if I'm in equilibrium on competitive goods, like this table, for example, this is a relatively competitive good. So there's some, design quality, there's some marketing, but it's a relatively small price differential that you can achieve using marketing or design, right? So what it
you don't
really
get the design within reach catalog. Those things are expensive. This
well,
is a nice table.
but here's the thing. Let's look. So there's two parts of it, right? There's the immediately traceable energy consumption, which is okay. I had to plant the seeds, I had to water the trees, I had to grow the trees, I had to harvest the trees, I had to transport the trees, I had to mill the trees, I had to get a carpenter to turn it into a table. There's some dude in the middle here who's the marketing and design guy, right? He still draws a salary, right? And the majority of his salary, he goes and he spends consuming energetic goods. So if he is a competitive player in the economy, he isn't making much above what somebody else could make. And he's also then consuming the energy indirectly through the things that he consumes. Right. So even his sort of intellectual salary, which is IP and intelligence and whatever that is, that's still also technically a competitive good. And if he's consuming what he makes, his mind share is represented in energy just the same as the milling and the transporting of the wood.
So I distracted you. All right. So what's the next step? How do we get to the proof of work and Quai system?
So when we talked about the sort of second class of stables, one of the big issues is the oracleization problem. Yeah. And so the realization here is that miners can act as oracles. Yeah. Because if I look at a proof of work system, the majority of the cost is associated with the electricity to power the ASICs or GPUs. Right. The actual capital cost is very low relative to the energy cost. Right.
Over a long period of time, amortized, and sure, you got big fixed inputs. Capital costs up front, but hey, you go over a long enough time and you amortize it, and especially if you have a more decentralized mining market, I hear you, right? So over the long term, the primary mining cost is on a variable marginal basis is energy inputs, is what you're
Right.
saying.
Yeah. I mean, if you look at mining operations, when it like nets out, maybe 3 to 4% of their cost is associated with capital and operations, and the other 95, 6%
Over lifetime, yeah.
is just straight electricity purchases.
Mm-hmm.
Right. So they have this like reference to energy essentially, which is like, what is a hash? They are a producer of a hash, and their primary cost of producing that hash is electricity.
Mm-hmm.
Right. So they can act as an oracle, because if they produce a hash and they can sell that hash at market above their costs, they'll keep producing. If they can't sell that hash above cost, at some point they're going to stop producing. Right. And so they can literally become an oracle of how expensive it is to produce a hash, which then can become an oracle for what the real value of the electricity is that goes into producing that hash.
Right.
And the cool part is, because a proof of work system is using that for security, you're not creating like these weak, brittle oracleization things that are dependent on a one sort of market with a potentially illiquid book. The entirety security of the proof of work chain is also the oracle.
Right.
Right. Which is like a beautiful solution to how do you get an oracle without introducing centralization. You use the exact same mechanism for consensus so that you don't introduce any new points of trust or dependencies.
Yeah, it's really an elegant idea, right? Which is that, the dollar isn't super like stable in a robust way over long term. What might be a better measure of that in most people's lives that are applicable to their purchasing power over a period of time, yet are still relatively stable on a short term basis for commerce? Energy is a great choice for that. How do we get energy represented, or the price or value of energy represented on chain? Well, if it's a chain, proof of work actually provides that oracle mechanism. It can be represented there in a totally decentralized, incentivized way, which is like that. It's a really, really attractive and elegant way to come up with an idea for a decentralized, robustly stable coin from there. So that's like that I think was like, we took a long way of getting there, but that's the nuts and bolts, right?
Yeah. So once you kind of have that, then you have to get into how do you make that work? Right. So basically, there's two things in the system that like make this all work. The simple point that this makes is that if I create a token, chi in this case, that is emitted proportional to the hash rate, that token should have a value which is tied to the price of production of the hash, which is then tied to the price of energy. Mm-hmm. So then chi becomes sort of this energy dollar in some ways. It becomes a numeraire of energy. You're not trying to peg it to something. It's just, it represents sort of like a certain number of hashes. Those hashes have a certain amount of input to produce. That is what chi is, right? Now, the problem, though, that you have is that has only sort of created an equilibrium behavior for the miners in an equilibrium of demand environment. So if there's too much chi or there's too little chi, you need a mechanism to either increase the supply or decrease the supply so that the price can go back to the price point of production. Right.
It's stock and flow. You have a perfect match on the flow side. You're only producing chi at the same pace, but if demand changes, how do you take it out quickly or add it more quickly from the existing stock?
That's right.
Got it.
That's right. So like what the miners are doing here in this like first choice is really creating this stickiness, this point. I think it is a Schelling point.
Yeah.
I don't know if that's...
yeah, we've debated.
We've debated this term.
But fair enough. Go on.
Yeah. And anyway, you've created a marketable point where the market expects the price to return to in equilibrium, which is the price of production, which is then the price of energy. Now, the question is then, what gives you that mechanism to control the total supply of chi so that it's responsive to changes in demand? Changes in demand could be everyone suddenly realizes chi is this cash-like thing and it has low fees perpetually and it's cooler than the dollar. So they all want to get on the energy dollar, and maybe a nation state adopts it as their national currency, or Coinbase lists it or something like that. Yeah. Then there's going to be sort of like a stepwise shock to demand up, right? And then the supply of chi will need to increase so that its value, again, is still reflecting energy prices. Conversely, maybe a country decides to ban the use of chi in its jurisdiction, which would be a negative shock, and you need to be able to soak supply out of the market. So the idea with the second token, Quai, which is more of a traditional deflationary token, whose issuance is proportional to the logarithm of hash. It's not proportional to hash, but logarithm of hash. That sets it up to be deflationary over time. So its curve sort of logarithmically approaches like a finite value over time. You can use that to sort of counterbalance chi effectively. So Quai, because it's deflationary, you should think of it kind of as a store of value. It's going to be quite a bit more volatile. But what it can do is you can create a system wherein you can trade Quai for chi or chi for Quai. And in doing that, you've created a market mechanism that provides issuance and it provides destruction of chi such that chi can always have the right amount of supply in the market. And the way that that's done is really sort of it's a pretty interesting and somewhat beautiful design. We set up an endogenous exchange rate, and the controller for the exchange rate in the protocol.
Exchange rate for what? What do you
Quai
mean
to chi and
by-
chi to Quai.
Got it.
So there's a native rate in the protocol that's always being calculated. And what the controller is doing is it's trying to make it so that the market is neutral to the exchange rate. So if the market is neutral to the protocol offered exchange rate, it means that the protocol offered exchange rate has matched the market rate. So it is like the correct pricing. If I went to the exchanges and said like, how much can I buy a Quai for? How much can I buy a chi for? How many chi per Quai is there? When the preference endogenously in the protocol is matching the market, like that endogenous rate will be the market rate. Because if it was high, people then preference trading chi for Quai or Quai for chi, which would then move the exchange rate, right? It would also adjust the supply until the offered rate comes into line with the market rate. And it does that simply by balancing preference. So obviously you can measure how much chi was mined, how much Quai was mined, how much chi was exchanged for Quai, and how much Quai was exchanged for chi. And then all the controller has to do is try to get that to be equal.
So let me try to summarize like the kind of full supply chain here, or the full like idea supply chain here is, all right, you want a stable value. You want it to be decentralized. You want it to operate at scale like money for payments, things like that. What value are going to use that's robustly stable? Energy is a great choice, as we discussed. Oh, it has this nice property that you can represent that value or price of energy on chain in a decentralized way using proof of work. Great. Then you issue a token called chi in direct linear proportion to that proof of work and the cost of energy. Great. You now have emissions function for supply. What happens if there's a demand shock up or down? Well, you need to immediately soak up or add supply. So you need a second token that acts as implicit collateral that is basically a scarce, valuable token called Quai. And you set an exchange rate via decentralized kind of like ratio between them. And that acts as the buffer and or, I guess like lever to maintain that supply imbalance in or out very quickly. And then Quai as a result is not only like scarce in supply, but is kind of buoyed by market demand for chi. That's kind of like the overview of the system. It sounds very complicated, but that's kind of it overall.
Yeah, I mean, in reality, it's really simple, right? There's really two things that are going on here. We're setting up two market equilibrium points. One is that chi should reflect the price of production, and that is electricity.
Yeah.
And if the exchange rate has matched the market perceived exchange rate, there will be a neutral preference by market participants.
Right. By neutral preference, you mean like indifference. Like
indifference.
They're equal price. Basically.
Yeah, there's an equal amount of preference for converting Quai to chi as there is converting chi to Quai or mining. So like in aggregate, the total value flows are equivalent. So there's net zero value going between the two. That means that the exchange rate is correct. That's like the two things that are set up here. that's it. Those are like the full set of assumptions, and then you just design a controller against it. But
So-
that's the whole thing.
Before we get into like some, if there's any questions, and bring other folks up to ask them, or we can handle them one off. Real quick, I have some hypotheses about the future of the stablecoin market.
Well, I do want to maybe just
you got something else?
Interject here with something. The other thing that you should consider here is when we're thinking about the relationship between Quai and Qi. If Qi didn't exist, Quai would have a certain emissions curve based off the natural adoption rate reflected in the hash rate.
Mm-hmm.
By introducing Qi, that emissions curve is necessarily slowed down or retarded over what it would have been if it were not for Qi.
They're competitive substitutes.
Right. So for Qi to exist, it comes at the cost of not producing a Quai.
Right.
So if a miner wants to choose Qi, they did that in lieu of producing a Quai. If you want to mint a Qi, you have to choose it from a miner's perspective, or I could destroy Quai to mint Qi.
Mm-hmm.
Now, conversely, obviously, then if the supply wants to shrink, Qi has to get destroyed to make Quai. So now you're minting Quai. But the point that I'm trying to make is sort of the value of Qi is drawn from the value of Quai. Mm-hmm. So if there is value in Qi, that came by, in some ways, like to put it simply, from a market perspective, every Qi that's created kind of looks like somebody is buying one Quai worth of Qi. Mm-hmm. Right, so if there's suddenly $1 billion worth of Qi in the world, it meant that there's $1 billion less of Quai
right? They have foregone
in the world.
Minting Quai, yeah.
That's right. Or they converted it. They literally destroyed it.
Fair enough. Yeah.
Right, so they either slowed down the inflationary emissions, or they literally took it out of circulation to create that Qi.
Yeah.
So Qi is very much inside of Quai, so it's additive to the
Mm-hmm.
Total system value. It's not like you have two systems. It's you are adding utility to Quai, and when you mint Qi, it is causing the value of Quai to also rise.
Yeah. So in terms of like where the stablecoin market goes from here, because look, we're talking about these like new, novel, kind of elegant, but still new, up and coming ideas, and we're talking about the fact that bottom line is today the stablecoin market is like entirely USDT and USDC, both in terms of monetary base and transaction volume. So I have some kind of like hypotheses about like how it goes from here, but I also want to hear yours. My two are that one, I think that the US dollar and US dollar denominated centralized stablecoins are going to continue to do well, even accelerate their performance over the next 5 to 10 years. But it's kind of like in a tsunami scenario, the tide goes out before it all comes crushing back in. You will eventually, look, it's not sustainable. What time horizon is, we can argue over. But I actually think that what you're seeing right now is, and what you'll continue to see even more accelerated, is people are getting access to the US dollar that they've never had before. And that is actually super desirable in other places across the world. At some point that will snap back, and then I think we get into these novel ideas, and it may, it's slowly and then all at once, right? So that's one thing. I have my hottest take on this issue is that the idea of money goes away entirely. In the world of AI agents, and assuming frictionless, seamless capital markets and liquidity, why wouldn't I hold, we're talking about our purchasing powers, why wouldn't I hold a basket or portfolio of assets that matter to me? You hold a basket of or portfolio of assets that matter to you. And then when I want to buy something from you, our agents, our autonomous agents, seamlessly swap this little basket of mine into a basket of yours and rebalance it. So I actually have a take where if we move to a world where an increasing amount of GDP and economic activity occurs through autonomous agents, and you have totally seamless and frictionless capital markets and liquidity, money goes away entirely. So that's my like kind of hot-ish take, and then super hot take. Where are we going in the stablecoin market for you?
Okay. I think given the concepts.
Imagine there's no money. It's easy if you try. Sorry, go on.
I think I think your dream is going to be like fusion. It's always going to be 20 years out.
You may say I'm a dreamer, but I'm not the only one. Go on, Carl.
Yeah. So I don't think we're going to get quite there anytime in the future. I do agree with you that there's a lot of demand for stables, and that demand's likely going to grow. However, I also think it's interesting the risk profile around stables because they're so highly regulated, and also just the risk profile around the dollar itself. Yeah. Right. If you look at stables, it's interesting because it actually sort of fractures what previously were very like aligned powers at some level. Which is the Federal Reserve and the Treasury, i.e. the government and the banks. Right. So up until this point in time, the Fed has been the issuer of the stable coin, which is the dollar itself. And the Treasury has been the issuer of bonds, right? So when the Treasury sells a bond, it effectively is going to the Fed directly or indirectly, and they're making more money to sort of buy that bond, and then that money goes into circulation. And then the government, you and I, ultimately have to then pay back the Fed, the maker of the money, at interest in the future, which means we then must borrow more money.
Sounds like a CDP.
From the Fed, right? It could be an Ouroboros, David.
Yep. Turtles all the way down.
So that's kind of like how the system has worked. Now, the interesting thing is when you get on-chain stables like Tether, for example, where they're effectively the issuers of the dollars, they're also the buyers now of the debt.
Yeah.
Right? So from the Treasury's perspective, they should be rationally indifferent to USDT or the Federal Reserve.
Right.
Which is like crazy because like you've literally divided this sort of monopolistic, like perfectly aligned relationship that's happened for almost 110 years.
Aren't they like top 10 like T-bill holders?
Yeah,
or
like
nuts. Like
it's definitely top 10. I think it's maybe even like top 5 or something.
That's insane.
I think it's non-sovereign.
Fair enough.
Was the
predicate.
Up there,
but they've entered.
Yeah, it's definitely the top 10 non-sovereign holders of government debt. Right. So the question then is who really controls the government long term, right? If the government is really independent of the Fed, then like stable coins should do quite well. If it's not independent of the Fed and the banks like control the government indirectly, you're going to see regulation clamping down on the private issuance of these stable tokens. It's not done through the incumbent banks.
I thought the government was by the people for the people, though. The banks, you're saying?
By the JPs for the JPs.
The banks, you're saying. Yeah, I actually think so. This is like also banks are a deputized arm of political power for countries. It's how we actually initiate sanctions and certain capital control measures. So like the idea, this is a CBDC thing that I have. When people have this concept of CBDCs, they think of like, oh, I'm going to be able to have an account with the Fed, or Feds are going to issue us to us directly. I actually think that will never happen, certainly not in the US. You need to have banks. Like our system is designed. The financial surveillance system.
I don't know if you need to have banks, but certainly the power structure
currently
has them very entrenched.
Yeah.
Right. So, I mean, even CBDCs are kind of like a crazy idea because more naturally, you could say that the CBDC is just a treasury function. It's not a banking function at all.
Right.
You don't need the Fed. You don't need the private issuance of money, but that's how the whole system works, right? And it's crazy. You know, when I first learned about this, after learning about Bitcoin, it like all felt very conspiratorial.
Yeah. You're not a fan of Alexander Hamilton? Did you see the musical? I heard it was great.
I haven't seen the musical
Alexander
yet.
Hamilton, for those outside the country, is the architect of much of the central banking function in the United States.
Yeah, it's actually like hard to find information on, especially was back when I first looked. You know, it felt like very deep, like rabbit hole conspiracy stuff. But like nowadays, if you look up what I'm saying, you can go to the St. Louis Fed's website and be like, who owns the Fed? And they'll be like, the Fed is a chartered private institution, and the shareholders are all the FDIC certified banks that like exist in the country,
St.
and
Louis
like you must
branch
have.
is great, dude. Their Fed data set's actually awesome. So kudos. Let's give some kudos to the Fed system. That particular branch, the St. Louis one, actually has some incredible data sets and information on their website.
Yeah, no, they really do. Well, they also have some good propaganda too, right? Like
tomato.
M1, M2, M0. What happened to M0? That doesn't even exist anymore. Don't worry about that, David.
Yeah.
Let's just redefine what the money supply is. But it was very like conspiratorial. But like if you look it up, right, the Fed is owned by the private banks. The private banks are shareholders in the Fed. They're the ones that feed the representatives into the regional boards, which then go into the federal New York Reserve Board or whatever it is. And then the chair is appointed by the president or Congress, one of the two. I don't remember.
It's the president.
Is it the president?
I don't know. I need to check that, but I believe so. Let's double check.
And anyway, there's basically
we need someone like Joe Rogan has to fact
Jamie.
Who appoints the Fed chair? Who appointed Powell?
Yeah, but that's basically the only purview that the government has directly on the Fed is who the Fed chair is. Everything else is really just the private banks doing what they will. Now, obviously, the government could potentially influence them via regulations, but even things like reserve requirements are driven by the Fed, not by the government. So, right, and we've been on zero reserve requirements since SVB. If you didn't know about that.
I've heard that. I've heard Balaji say that, or Balaji say that.
No, we're in a zero reserve environment right now.
I will say I have to denote, I actually am a fan of the financial system. And I think that the welfare in the United States and globally has been not only enhanced, but would have been impossible without the capital markets and financial system in the United States and the Western world. And it has created so much welfare. I do think we're at a turning point in technology and humanity where
someone lived in New York too long.
No. It's we couldn't have achieved what we achieved without. I mean, the capital markets and the financial system and that we have had has helped scale the Industrial Revolution, and as a result, bring unparalleled on orders of magnitude welfare across the world, and reduce child mortality to next to nothing in the Western. You like children, right? So you're against them dying, yeah?
Yeah.
All right. So that's brought to you by J.P. Morgan. You like whales?
Well, I also dislike seed oils and pharmaceutical companies.
Yeah.
So,
but nonetheless,
I mean, what we're getting at is that capitalism is a good system to have emergent laissez-faire economics generate positive outcomes. You don't need the type of money system that we have to do that. It's just we haven't had the tools to transcend this type of money system up until this point. Right. Gold kind of did it, but gold has its issues, even in a non-digital environment. Yeah. So, maybe, they had their place at some point. They certainly took their rips in ever-increasing proportions. And so did the government with their taxes. So, we need to put the money back into the control of the holders of the money. We need to give optionality to the money. It's much better to have an anti-fragile, evolutionary, emergent system than it is to have a top-down system, both in terms of robustness as well as in terms of ensuring that you get emergent laissez-faire outcomes, right? And we can now do that because we can create decentralized systems at scale. Even with Bitcoin, we haven't been able to do that because we haven't been able to run at scale, and we haven't been able to have an endogenous unit of account. So we are wholly dependent still on the dollar. Right. The goal here with Quai is that not only can we scale, but we also can create a decentralized monetary system. So not just a store of value, but also a unit of account and also medium of exchange, so that people can literally defect and never go back. Yeah. That is my goal in life.
Yeah. Look, we agree on the premise of crypto, the value prop of crypto, and that the time is now and the transition is happening. I think we can also agree we're starting to go off the rails a little bit here. So I don't know if anybody did have any questions or hands up that we wanted to address at all.
Yeah. Let's see. Comments.
No questions. I can check them from here.
You can check them there. Great. Cool. Well, I don't know. We can wrap this up unless you wanted to keep going.
No, we can keep going for a little bit.
All right, we might keep going off the rails. Stay tuned.
I mean, do you care?
No, we're good. We're good to go. Yeah. So one thing I'm interested in is, and I've asked you this before, energy versus like compute. If we're entering the age of information, we're entering the age of AI. Why wouldn't like compute or the value of computation be as good of, if not better, a measure to base robust stability of your unit of account or currency on than energy?
Because it's a derivative.
Derivative of what?
It's a derivative of energy. Energy is a more fundamental unit than compute. So, I mean, that's like, I could also make the proposition that we're in the era of tables.
Tables?
Yeah, of tables. So, like, we should price everything.
Are you talking like databases or like kitchen tables?
Kitchen tables.
Okay.
We're in the era of tables. So, like, tables should be the numeraire, like, of the economy.
There are a lot of tables, I guess.
But it's a derivative,
okay.
Right?
Yeah, of wood and labor and
right. Just like compute
yeah.
is a derivative of silicon and fabrication and our massive supply chain that's dependent upon that, and a couple very small concentrated companies, rare earths, so on and so forth, right? And it's also a competitive good against other things, right? And that's actually like a very good conversation.
Which part?
The best form of money should not be a competitive good. 100%. So like I'll just like throw that out there right there.
So you mean like shouldn't have like other like industrial or productive uses?
That's right.
Okay.
100%. Yeah. So like, let's just think about gold, right?
Yeah.
The reason gold is the most used metal for money in history is because it doesn't have, so it's durable, obviously, so it doesn't corrode or anything. It's shiny, but the sort of monetary use of gold versus the non-monetary use of gold, it's something like 95% of it is monetary use, and like the other like 5% is like decorative, industrial, and jewelry sort of stuff. So it's very good in that regard. If we compare that to something like silver, the amount of silver that's mined every year is industrially consumed.
Like the whole amount?
Yes.
Interesting.
So I mean, it's like the opposite. So maybe like 5% of silver goes into like a monetary like use case, but the other 95% of it's industrially used. Yeah. We use it all over the place. We use it for connectors. We use it for conductors. We use it for solar panels. We use it everywhere. Yeah. So the majority of silver production is industrial. So if I have a change in the demand for solar, if I have a change in the outlook on the economy, it's going to negatively reflect in the price of silver or positively reflect in the price of silver. So silver is not a good energy unit because it is convolved with many other societal factors. It's also why I don't think compute's a good energy or unit, because it's too overly convolved with too many things, right? But if we look at energy, energy is tables, energy is compute, energy is microprocessors, energy is, buildings and ceramic cups, right? All energy is in all of those things. So it's the most universally, ubiquitously used thing. So it has the least amount of industrial dependency of any good. Right. Now, it obviously is tied to that. So if you do look at energy prices will rise and fall with the economy. But in some ways, that's actually a good form of money because it means that if you denominate in an energy-denominated unit, you can actually instantaneously reprice your supply chain without actually having to change any of the pricing, at least for the energy constituent of the price of goods. Yeah. So that's why I get into an argument with you over the compute versus energy. Yeah, compute's such a it's I guess they're both kind of intangible, but compute especially, right? And compute is like made up of many other things. As is like I guess like energy is too, but like they're more like you're talking about a blend rather than a bunch of different things. In the age of information, if you're saying like compute is probably the most competitive good. Rather than the least competitive good. I mean, if you're moving into a world where more and more. Well, I mean, so yeah, like you could argue that. It's just the issue is Right now, that's not true.
Right now, it's not, right?
Because there's so few actual manufacturers and suppliers of that compute.
That's fair.
It's not that good of a mechanism. I mean, if we want to be honest, right, that's probably the weakest point of this whole system design of Quai is that
the supply chain for like chips and compute.
Yeah, I mean, so if you look at it, right, we made a conscientious choice to use GPUs over ASICs. Now, we did that from a geostrategic standpoint, which is if we want to ensure that people can get access to GPUs and access to mining, it is much more difficult to curtail the import and export of general purpose hardware than it is application specific hardware at national borders. Like that's why GPUs were chosen. Now, it's also was chosen because we said, okay, that's a more competitive market, but in reality, the GPU manufacturers are still only a couple guys. Now, they supply the world, so they're not sort of specific to one thing, and they're competitive with each other for many use cases. So that helps, but there's still really only two of them.
Yeah. I think there's going to be, don't you think there'll be increased competition, or no, it's even going to become more centralized? What do you see that dynamic looking like?
Oh, it's kind of funny, right? They're threatening NVIDIA with a lawsuit, an antitrust lawsuit, like 2 weeks ago, not even 10 days ago.
Well, there's like, I guess, increased maybe subpoenas or something, yeah.
Yeah, well, I mean, I don't know, like the degree of advancement or severity. Right. It was mentioned, and NVIDIA definitely corrected because of the mention. You know, I think it's healthy to have, you know, more diversification. It is hard though with some of these highly complex systems that we build to have good diversification. Because if you look at the process of semiconductor manufacturing, because it's being driven by energy consumption, actually, and they're shrinking node sizes all the time and trying to make things more dense and more efficient. In that sort of highly complex, competitive, it's not just efficiency, it's competitiveness, right? So like when you look at selling energy, right, like the chips are like such an important part of that. And if you're selling a chip that's, you know, half as efficient as somebody else's chip, but you're not going to sell any chips, right? Because like no one's going to want to buy them because the watts per flop like aren't there, right? Well, you're not going to be able to sell it because like you're not going to be able to offer competitive good, i.e. compute, data servers, whatever, because you're just spending more energy per flop, right? People aren't going to want to buy your service. So that sort of characteristic of the chip market has caused the chip market to be very uncompetitive in that way, where you get a few winners with the vast majority of market share. Now, I think over time, we're kind of approaching what will be we've obviously seen, I think, Moore's Law kind of die at this point, certainly for microprocessors. I think we'll also see it tap out for FET-based GPUs by 2030, 2032. Once that happens, I think you will get a re-diversification in the supply chain because that competitive race will end and that will become more of a commodity good because it won't be defined on who can get to the next node size. It will be defined at the node size we are at and going no further, who can produce the most things for the lowest cost. So that will turn into a competitive environment once the scaling wars sort of stop in decreasing node size. So I think long term, like we will get more competitive markets, but circularly, yes, that's one of the worst dependencies I think work-based systems have. Yeah.
I'm seeing one question here about, do you see any actual, what's the closest decentralized stablecoin that you're seeing on the market today? Are there any that you look to and see that there's interesting things, even if they're based on USDC or USD or otherwise? Is there anything that is like an interesting decentralized design in the market today, or is there just like a total dearth?
I mean, there's a couple other projects that have some proposals and some things in the market. I'm gonna probably need help with the names.
I think I've heard you talk about Reflexor and Rye.
Rye is the Ethereum volatility one.
That's right. Yeah.
That one's a reasonable design. The same guys who kind of did their controller design and economic analysis, block science, we actually contracted to help us with our controller design. But Rye is a good example of something that's in the market that I think is a good design for generalized stability. It's not really tied to real world assets, but if you look at their chart over, I think it's a 4 or 5 year period, they actually did a decent job of keeping something relatively stable over that period of time without really having external oracles or sort of hard pegged references, which is impressive. I think having a design where you get back to a real world asset is the way to go, because it's not just about volatility of Ethereum price and sort of hypothecating something out of that. It's about having money that's tied to the real world. I think is a better design. I think it's more stable over time than a strictly hypothecated design. But out of the ones that exist, I think that's probably the best example that I've seen. There's a couple others I know you mentioned.
Yeah, there's some other ones out there. I think like Gyroscope's one some people like. High is another version of Rye that some people have liked. But look, if you're trying to create a USD denominated one, like you're going to face similar issues. There's some interesting ones with doing the CPI or like an inflation based
flat
coin
tokens
stuff. And they do it with an interesting mechanism, like from a financialization perspective. It's interesting how they tranche it and separate out the volatility versus others.
I think it's ridiculous to try to
challenging.
I think it's ridiculous to try to tie things back to the dollar. You're not going to be able to come up with an endogenous system that's pegged to anything, let alone the dollar.
Yeah, that's robust and resilient. It's challenging. Yeah. I think I'm seeing one other question here. I want to get to before we wrap things up. Is it's a little bit about privacy, which is that, but more so about like USDC, USDT. They've been pretty good, I think, about not freezing people's accounts. Certainly not like the Canadian government or anything, but it raises the question about, do you need privacy for a stablecoin, or can you get it far enough with just censorship resistance decentralized thing like a Bitcoin type thing? Or how do you view that place in the market?
I mean, I think Bitcoin at this point, however much I love it and like what it introduced, I think it's like utterly failed as a technology in terms of its scale, in terms of its utility. And one of the obvious sort of death knells in it is the complete and utter lack of privacy in the system, right?
I love Bitcoin. I have a different opinion, but I very much agree about privacy being a big weak point for sure.
Yeah, I mean, I still have exposure to Bitcoin. Yeah. So in that regard, like it still is the dominant crypto asset. Yep. But if you look at the original vision of creating state-independent money, it has certainly not achieved that. And the characteristics that it has in the base layer, with the lack of scaling and the lack of any modicum of privacy, I think it makes it impossible for it to achieve that. So, right, my ultimate goal is to accomplish Bitcoin's original goal, which is state-independent money. So, with Qi, there are cash-like properties, right? It is a fixed denomination UTXO ledger, and we enforce non-address reuse per block in the protocol. That means if you have a, just normal wallet, you will want to follow what is considered good privacy practices in Bitcoin, but you would have to go well out of your way to not use good privacy practices. Would be like a good way to put it. You could, but like the natural design philosophy of a wallet with those two characteristics is to make something that keeps a good amount of entropy in the aggregate set, which makes it look like cash when it's spent. So it's not perfectly private. It's certainly traceable and trackable if you want to reveal accounts and addresses to people, so it's auditable for businesses. But at the same time, if I'm a business and I'm a competitive business, I'm not going to be leaking all of my revenue in my consumption, in my pricing, in my producer pricing to my competitors when just conducting normal business.
Right.
It allows enough privacy for that while simultaneously still being auditable. So if I'm
Right.
a business, I'm still going to be able to have corporate controls. I'm still going to be able to track, probably better than cash, what revenue and what sales I had. But from a public standpoint, unless you see those sort of audit keys, you're not going to know what's going on with Chipotle or Freebirds.
Yeah, I can't see what everybody's buying from my local Chipotle.
That's right.
Like today. Yeah, that makes sense.
Right.
Yeah, that's a good answer. I mean, that's interesting.
I almost think that's a prerequisite to even be considered as a replacement for money.
Yeah.
Is that you need to have cash-like characteristics, because if everybody is leaking all of their data to everybody else for every transaction, we can't have a capitalistic society, because we can't have competitive organizations, right? It's almost a prerequisite to get laissez-faire outcomes.
Right.
It's a predicate to get capitalism to take place, is that you can't be leaking everything about your business to everybody all the time.
Right.
You have to have at least that cash-like property. And with that, then you can build the digital system that allows for good outcomes.
Got it. All right. Before we wrap up, anything else on your mind? We've gone through the hour here. We're actually running long already, so I'm happy to wrap up. But is there anything else you wanted to cover before we did so?
No. Yeah. I mean, we can wrap it up here.
Cool. Awesome. Well, we'll have to do more of these, and we'll go in deeper in some of these topics or the next one. So we'll do it, and we'll make this recording available, I think. Right, Raleigh? Yeah. Awesome. So we'll do that as well. So we'll make that available. But thanks for joining, and we'll do it again soon, huh?
Yeah, it was fun.
Awesome.